Imagine a colossus towering over an industry whose fall sends tremors through the foundations of global economics. This is not the plot of a dystopian novel, but the real-life saga of Evergrande, a titan in China's real estate market whose collapse has rippled across the world's second-largest economy. The liquidation of Evergrande, once a symbol of prosperity and monumental growth, exposes the frailties and vulnerabilities within China's economic fabric, beckoning a closer examination of its implications and lessons for the future. Evergrande was not merely a company, but a phenomenon that epitomized China's meteoric rise in the global economic arena. Founded in 1996 by Huika Yan, it swiftly became one of China's largest property developers, renowned for its ambitious projects that stretched across the urban landscapes. Leveraging the urbanization wave and the burgeoning middle class, Evergrande's strategy was marked by aggressive expansion and massive capital inflows, setting the stage for unparalleled growth. However, beneath the surface of this rapid expansion lay a foundation built on precarious financial practices. The company's business model was heavily reliant on continuous borrowing and asset acquisition, a strategy that promised high returns but also posed significant risks. This approach mirrored the broader trends in China's real estate sector, where high leverage and speculative investments became the norm, embedding systemic risks into the economic system. Evergrande's role was pivotal in shaping modern urban China. The company's developments were not just residential properties, but expansive complexes that included malls, hotels, and schools, contributing significantly to the landscape and economy of numerous cities across China. This extensive influence made its subsequent troubles all the more impactful, setting the stage for a crisis that would test the resilience of the entire Chinese economy. The roots of Evergrandes Crisis can be traced back to a pivotal shift in regulatory frameworks and market conditions that exposed the underlying vulnerabilities in its business model. The introduction of the Three Red Lines policy by the Chinese government in 2020 marked a significant turning point. This policy aimed to curb the excessive borrowing habits of real estate developers by setting strict limits on debt ratios, directly impacting Evergrande's operational flexibility. Concurrently, the real estate market in China began to show signs of strain. The market dynamics shifted as the rapid pace of urbanization slowed, and the COVID-19 pandemic added another layer of complexity, disrupting economic activities and reducing consumer spending power. These factors combined to create a perfect storm for Evergrande, as it struggled to manage its massive debt burden amidst declining property sales. The initial signs of distress became apparent when Evergrande started delaying payments to suppliers and creditors, a move that triggered widespread concern about its financial health. The situation escalated quickly, leading to a loss of investor confidence and a steep decline in its stock and bond prices. These early indicators were a clear signal that Evergrande was teetering on the brink of a financial abyss, setting the stage for a crisis that would have far-reaching consequences. Evergrande's debt structure was a complex web of domestic and international bonds, bank loans, and informal borrowing, which became increasingly unsustainable as the company's financial health deteriorated. When Evergrande officially declared a default on its debt, the immediate repercussions were profound. The announcement sent shockwaves through China's financial markets, leading to a sharp decline in the stock prices of numerous Chinese real estate firms and banks. The contagion effect was palpable as the fear of a systemic financial crisis began to take hold. Investors and financial analysts closely monitored the situation, concerned about the potential for Evergrande's troubles to trigger a broader financial meltdown. This scenario highlighted the interconnectedness of the financial sector and the real estate industry in China, where the collapse of a single entity could potentially destabilize the entire economic system. The government's cautious approach to the unfolding crisis was evident, as it intervened to stabilize the markets while trying to contain the fallout. The central bank injected liquidity into the banking system to prevent a credit crunch, and regulators worked closely with Evergrande to facilitate a structured default process. This critical period in the crisis management underscored the challenges of balancing market forces with regulatory oversight, a theme that would continue to resonate as the Evergrande saga unfolded. The impacts of Evergrande's default were not confined to the Chinese markets. They echoed across the globe, unsettling international investors and shaking global financial markets. The news of the default led to a downturn in global stock markets, particularly affecting companies and funds with significant exposure to Chinese assets. This international dimension of the crisis underscored the global interconnectedness of modern financial systems, where disturbances in one nation can lead to widespread implications. Foreign investors who had poured substantial funds into Evergrande and other Chinese real estate ventures found themselves facing significant losses. This situation raised concerns about the transparency and regulatory environment in China, prompting a re-evaluation of risk among international investment communities. The Evergrande episode became a case study in the risks of global financial integration, where local economic policies and company-specific issues can have far-reaching effects. The lessons for the global real estate and financial markets are profound. They highlight the need for better risk management practices, more robust financial oversight, and a deeper understanding of the systemic risks inherent in global economic interdependencies. These insights are crucial for investors, policymakers, and regulators around the world as they navigate the complexities of an increasingly interconnected economic landscape. In response to the unfolding crisis, the Chinese government took decisive action to mitigate the impact of Evergrande's collapse and to prevent a broader economic meltdown. These interventions were multifaceted, involving both immediate measures to stabilize the financial markets and longer-term reforms to prevent similar crises in the future. Initially, the government focused on ensuring liquidity in the financial system, reassuring investors and the public of the stability of the banking sector. This was achieved through a series of measures, including direct interventions by the central bank and regulatory actions aimed at maintaining confidence in the financial markets. The authorities also facilitated negotiations between Evergrande and its creditors, aiming for a structured and orderly process of debt restructuring. Beyond these immediate actions, the government also embarked on a broader overhaul of regulatory policies within the real estate sector. These reforms aimed to address the root causes of the crisis, such as the high levels of debt among property developers and the speculative nature of the real estate market. New regulations were introduced to limit borrowing and to promote more sustainable business practices among developers. These government interventions reflect a strategic approach to crisis management, balancing short-term stabilizing actions with long-term reforms. The Evergrande crisis has served as a catalyst for significant policy shifts in China, with the potential to reshape the landscape of the real estate sector and to enhance the overall stability of the Chinese economy. The immediate effects of Evergrande's troubles were sharply felt in the real estate sector, with a significant slowdown in property sales and a decline in market prices. This downturn was partly due to reduced consumer confidence, as potential buyers became wary of investing in a market that appeared increasingly volatile. The ripple effects were widespread, impacting developers, suppliers, and various stakeholders across the industry. In the longer term, the outlook for China's real estate market remains uncertain. The sector, which has been a significant driver of economic growth in China, now faces a period of adjustment as it grapples with the implications of Evergrande's collapse and the government's regulatory reforms. These changes are likely to lead to a more moderated pace of growth, with an emphasis on sustainability and reduced speculation. The impact on residential and commercial properties varies, with some regions and segments feeling the effects more acutely than others. The luxury property market, for instance, may experience a different trajectory compared to the mass market segment, reflecting differing consumer behaviors and financial dynamics. The overall adjustment in the real estate market will be a critical factor in shaping the economic landscape in China in the coming years. The banking sector, which had significant exposure to Evergrande's debt, was among the first to feel the impact of the company's financial troubles. Banks and other financial institutions faced the prospect of substantial losses, which could affect their balance sheets and overall financial health. In response, banks tightened their lending policies, particularly towards the real estate sector, and took measures to increase their liquidity to manage potential shocks. The measures taken by banks to mitigate risks included increasing their capital reserves and re-evaluating their credit exposure to high-risk sectors. These actions were crucial in preventing a more extensive financial crisis and in maintaining stability within the banking system. The regulatory authorities also played a key role, overseeing the financial health of banks and ensuring that they adhered to stricter financial standards. The overall impact on China's banking industry has been significant, prompting a re-evaluation of lending practices and risk management strategies. The Evergrande Crisis has highlighted the need for more robust financial oversight and has led to a more cautious approach towards lending in the real estate sector. These changes are likely to have lasting effects on the banking industry, influencing its operations and strategies in the future. The Evergrande Crisis has had a profound impact on consumer confidence, particularly in the real estate market. The uncertainty and financial instability associated with the crisis have led many consumers to reconsider their investment decisions, resulting in a slowdown in new property purchases. This shift in consumer behavior is significant in a country where real estate is a major investment channel for households. The impact on homeowners and investors has been varied, depending on their exposure to the crisis. For some, the decline in property values and the uncertainty surrounding Evergrande's projects have led to financial losses and a reassessment of their investment strategies. For others, particularly those with less direct exposure, the effects have been less immediate, but the overall market sentiment has been affected. The social implications of the real estate downturn are considerable, affecting not just individual homeowners and investors, but also the broader community. The slowdown in construction and real estate activities has implications for employment and economic activity in regions heavily dependent on this sector. Additionally, the loss of consumer confidence can have a cascading effect on other sectors of the economy, highlighting the interconnected nature of economic and social dynamics. The Evergrande Crisis has brought issues of corporate governance and ethics to the forefront, highlighting the need for stronger oversight and more responsible business practices. Evergrande's aggressive growth strategy and high leverage are indicative of broader governance issues within the company, including a lack of transparency and inadequate risk management. The discussion on ethical considerations is particularly relevant in the context of Evergrande's impact on investors, employees, and the wider community. The company's failure to manage its debts responsibly has had wide-ranging consequences, raising questions about the ethical obligations of corporations to their stakeholders. This situation underscores the importance of ethical business practices and the need for companies to adhere to higher standards of accountability and transparency. The broader implications for corporate governance in China are significant. The Evergrande Crisis serves as a wake-up call for regulatory authorities and companies alike to strengthen governance frameworks and to ensure that companies operate in a manner that is sustainable and responsible. This shift towards better governance is essential for building trust and stability in the market and for supporting China's long-term economic objectives. The Evergrande Crisis offers critical lessons for China's real estate and financial sectors, providing insights into the risks associated with high leverage and speculative investments. The crisis has prompted a reassessment of financial practices and regulatory policies, with a potential shift towards more sustainable and stable economic models. One of the key lessons is the importance of financial discipline and robust risk management practices. For companies, this means adopting more conservative financial strategies and ensuring greater transparency in their operations. For regulators, it involves enforcing stricter oversight and implementing policies that discourage excessive risk-taking. The future prospects for China's economy in the aftermath of the Evergrande Crisis will depend on how effectively these lessons are integrated into business practices and regulatory frameworks. The potential reforms in the real estate and financial sectors will play a crucial role in determining the resilience and stability of the Chinese economy. As the country navigates these challenges, the outcomes will have significant implications, not only for China, but for the global economy as well. The liquidation of Evergrande is a watershed moment in China's economic history, symbolizing the end of an era of unbridled growth and the beginning of a more cautious and regulated economic environment. The crisis has exposed deep-seated vulnerabilities within China's financial and real estate sectors, prompting a critical examination of existing practices and policies. The multifaceted impact of the crisis, from financial markets to consumer confidence and corporate governance, offers a complex but instructive case study on the interplay between economic growth and financial stability. The lessons learned from Evergrande's downfall are vital for preventing future crises and for ensuring that China's economic development continues on a sustainable path. Reflecting on Evergrande's saga, it is clear that the balance between growth and stability is delicate and requires constant vigilance and adaptation. The path forward for China's economy will involve navigating these complexities with the hope of emerging stronger and more resilient in the face of future challenges. As observers and participants in this unfolding story, it is crucial to remain informed and engaged with the processes that shape our economic realities, ensuring a stable and prosperous future for all.